Hey everybody, welcome. This is our quarterly update video. I know everybody's been anxiously awaiting this. You can blame Cole for it taking so long. He just had a baby. We are going to cut this thing down to about 10 minutes. Clients have said that they don't want to stare at me for 20 minutes, and I can't really blame them. So without further ado, let's just jump right into U.S. stocks. The S&P 500 was up a little bit over 8.5% this quarter and nearly 30% for the year on a price basis, a little over 30% if you're including reinvested dividends. Volatility is all the way back down to those ridiculous levels we saw in January of 2018. We all know what happened in 2018. I'm not saying it's going to be weird, but it could be weird. Just a heads up, volatility is too low right now. This chart is really telling. Normally this orange line right here is going to go up at some point in time, and it's been a while since it's gotten up to a meaningful level that makes us uncomfortable. So just be ready for that, and that's part of the reason why we are broadly diversified in our portfolio. Now, you'd probably expect when we have a borderline record year in U.S. large cap stocks like we did last year, you'd kind of expect GDP to be going through the roof or something like that. But that's not the case. Right now, GDP is remaining stagnant. Not too exciting out there. We have been in and around the 2% area for quite a while. But if you remember what we talked about last quarter, the bottoming process or the decline in GDP can take up to 2 years. So we're kind of in a position where we're not really thinking there's going to be a recession right around the corner, but we could be 18 months out on that. That is not something I just came up with or pulled out of the clouds. Take a look at this chart here on GDP. Now, major stimulus could kick the can down the road on this recession thing, but something we can't really dodge at this point is employment numbers. Although they have remained relatively strong, they are getting weaker. This non-farm payroll chart is pretty definitive. We are seeing a year-over-year slowdown in almost every single month over the trailing 12 months. This is powerful stuff because we have lower highs and lower lows. That is not exactly a great chart setup for all of my chartist friends out there. A big driver of this is wages continually being pushed higher. We're seeing hiring level off a little bit, and then we're also seeing CapEx spending drop. Executives across the board are putting their helmets on, getting ready for things to slow down a little bit. A lot of this has to do with all the political uncertainty. I mean, this is one of the most interesting political environments we've ever seen. Trump has formally been impeached. This essentially means nothing at this point, but he is kind of in a position where he's been found guilty by the media, and even though there's only about a 5% chance that the Senate could actually go through with impeachment, it is still brutal from a headline risk perspective. Trump has definitely been telling us that the stock market is at all-time highs. That is no secret if you follow his Twitter feed. But what nobody's talking about is what the bond market's telling us, and that yields are continuing to fall and spreads are narrowing, and this is something that is powerful when it comes to defining risks in the marketplace. We're also seeing some interesting price action in gold. If you take a look at this chart here, this is unique because we are seeing the dollar weaken substantially in the face of global uncertainty. This is not necessarily normal. What is normal is gold prices increasing and there being a very negative correlation between the US dollar and gold. This US dollar weakness is a little bit of a buoy for international and emerging market stocks. The EU is still pretty darn weak. They've been in a recession for at least on and off for the better part of 10 years. This GDP chart that we looked at last quarter, we're actually going to compress this a little bit and just look at the trailing 12 months. And you can see, although it looks like it's attractive and things are going up a lot, if you check the y-axis, we are talking about less than 1% GDP growth, average quarter over quarter. This is pretty darn weak. On the bright side, it is not recessionary anymore. This is kind of what we were talking about in terms of rate of change, things getting a little bit better. than they were. And that's not saying much, but it's saying it could be the early stages of a recovery for the EU. Brexit is still front and center as a headline risk and geopolitical risk out there. Boris Johnson has secured the largest Conservative majority since 1987 with Margaret Thatcher. This could be pretty special for the UK, but they have to handle Brexit really well in order for this whole thing to play out the way that they're looking and the way that we're hoping in our portfolios at this point. Moving from an economy going from weak to less weak to an economy that's going strong to less strong, we are talking about China. There is a lot of unrest in China. There's a lot going on that we won't ever fully understand here in the United States. What's happening in Hong Kong is not helping matters. It's confusing issues there. That is a huge financial hub for all of Southeast Asia, and China is trying to strengthen their grip on them without strangling them. Their GDP rates are continuing to decline, and the bottom line here is that our tariffs have worked and they have been forced to the negotiation table. We are certainly not going to get everything that we are looking for with this trade deal, especially this stage one or level one trade deal. But I think it's important that they are at least willing to, on a public stage, show their willingness to negotiate with the United States. This is something that would not have happened even 5 years ago. Hopefully we are in a position to capitalize on this moving forward. At first glance, this doesn't look like a really important chart here, but what I want to point out is the undeniable fact that the tariffs are working. The trade imbalance has narrowed significantly. We went from $36 billion imbalance to around a $25 billion imbalance in just under a year. And that's powerful, and that's why we're negotiating. Things are looking up. We're definitely not going to get everything we want, like I was saying, but I think at this point in time, prospects are good that we will continue to move in the right direction with China. Moving from one problem spot to another, I'm going to address the Iran issue. This is just because clients keep asking about it. Frankly, Iran is inconsequential on global markets. What happens there really doesn't matter to most of us, with the exception of what's going on with oil prices. They are acting like a terrorist organization, and the rest of the world's finally seeing that. There's been disagreements on how to handle it, but we have started to make some changes the way that the globe is dealing with Iran as a whole. We stepped out of the nuclear pact a while ago, and Iran has now fully removed themselves. The EU was kind of crying about it, but the long and the short of it is it was going to expire in October, and it doesn't really matter. One bright spot with this whole ordeal is what's going on in oil prices. This is a place that we are finding opportunity in client portfolios and looking to add exposure. Something super interesting about oil price action is how it has been fluctuating relative to stocks that deal with oil and gas. On this chart, we have U.S. oil price changes in purple and a basket of oil stock prices in gold. I think this combo crystallizes the point I'm trying to make here. All of this volatility in the Mideast could be a major catalyst to see energy stock prices recover this year, and it could be one of the last energy bull markets as renewables seem to take root in the marketplace. At some point in time, I would wager to guess that energy stocks are going to be the new tobacco stocks, just generating a lot of free cash flow, paying big dividends, and not giving much in the way of returns. Now that we have all this data, I think it's probably pretty important to figure out what it all means. But before we get to that good stuff there, I just want to drop a couple of feel-good pieces of information on your plate right now. Employment is in great shape. So the U.S. consumer is strong. That is a positive. We're not going to war with Iran tomorrow. Also a positive? Yes, I think so. And probably the biggest positive of all is the fact that our toys for our cute little children and our electronics are not going to get more expensive due to tariffs. So I guess we can thank our president for that. I don't know. Hard to say who gets the credit. But to that end, What are we going to do with all this data? The bottom line is we're going to make some changes to portfolios. Some of the portfolios we've already made changes to. You've probably already seen this. But the long and the short of this whole thing is our data will dictate our positioning. You guys have heard me say that a million times, and right now positioning is as follows. Lower volatility has gotten expensive. You guys have seen the ETFs in your portfolio. We're going to trim those. They are no longer cheap. Cyclicals and commodities like energy and gold are going to be showing up in portfolios at some point this year. We are overweight internationals and emerging markets. We're also overweight alternatives and non-correlating asset classes. Bonds are a little bit underweight, and what we have is not quite as vanilla as what we've had in the past. That's something that's going to be a bit of a change for people. And please remember, our allocations are unique to every one of you out there. Every one of our clients is special and has particular needs that they need addressed, so no two portfolios are absolutely identical. It's really important to remember that. As always, thank you so much for watching these videos. We are eternally grateful for our clients, and we are excited to service new ones in the future. If you would like to schedule a review, go ahead and email us or click the link below and reach out to us directly. And if you are a new person watching and want to get in touch or want a portfolio review, we do those free of charge, so feel free to reach out. Thanks so much, and let's make 2020 an amazing year for all of us.